Hello friends, today we are going to talk about one of the very crucial concept of financial reporting. Today we are going to talk about what are financial instruments and what are the key accounting standards that govern the financial instrument concept in financial reporting. Friends, while preparing the financial statement and the reporting part of a financial statement, as we know, we have to report as per the applicable accounting standard, whether the applicable accounting standard is Indian accounting standard, that is Ind AS, or it can be international financial reporting standards, or it can be US GAAP. More or less accounting requirement, their measurement classifications are more or less similar to some extent. So let's discuss what are financial instrument. So financial instrument are basically a kind of a instrument that creates rights of one entity and obligation and equity for the another entity. For example, if we are making investment in equities, we have trade receivables. So what happen actually in case of this instrument, we have a right to receive cash and the another party has an obligation to pay cash to us. So for us it is an asset and it is a right to receive cash, that is the asset for us, whereas for the another entity that is obliged to pay cash to us becomes liability in their balance sheet. So now let us discuss how the financial instruments are accounted for. So basically, financial instrument accounting is governed by major accounting standards like IFRS 9 in case of a IFRS accounting entity, second US GAAP, third for India, the companies which are need to comply the Indian accounting standard, so they have to follow Indian accounting standard. Indian accounting standard, what we see is India's 32 and so on. So the standard is basically classified into three different standards. The accounting is classified into three different standards, and financial instrument is primarily addressed by three standards under the International Financial Reporting Standard Framework or otherwise. So first standard is IAS 32, that is financial instrument presentation. So this standard is talks about how the financial instruments related transactions need to be presented while while doing financial reporting. What item to shown as liability, what item to shown as equity, or one item to shown as assets, whether offset of these assets and liability is permissible or not. So there are condition attached therein. Second is IFRS 9 talk about financial instrument, provides the principle for the recognition, derecognition, measurement and impairment of the financial assets and financial liabilities, as well as it talks about how hedge accounting can be done. And the last standard dealing with the financial instrument is disclosure, how to disclose the financial instrument related transactions. It specifies the required disclosure in the financial statement that enable the users to evaluate the what are the significance of the financial instrument, what is the nature, what is the extent of risk arising from the financial instruments. So there are basically two part of financial instrument. One part deals with the accounting relating to the financial assets, and another part of the standard talks about how to account for the financial liabilities. So here we have given certain methods through which accounting can be done. So for financial accounting, the standards talks about there are three methods through which the financial assets in the books of an entity can be recorded. One is amortized cost method, second is fair value through other comprehensive income, and third is fair value through PL. These three methods are used for accounting of financial assets, whereas for accounting of financial liabilities like trade payables and long term goals are measured at amortized cost and using the effective interest method. So, friends, exceptions are also there. Exceptions include like financial liability held for trading, like derivative liability, or those designated at initial recognition to be measured FBTPL to reduce an accounting mismatch. And instrument classified as equity like ordinary shares by the entity represent a residual interest in the assets after deducting all liabilities. So they are initially measured at the fair value less the cost of less the issue cost, and no remeasurement is performed subsequently in the issuer books as the gain or loss are experienced by the investors. So we need the following consideration while the accounting standard to be applied, like initial recognition how to be done, day recognition to how to be done, impairment how impairment would be done of financial assets, and compound financial instrument how to be account for. So hopefully I'm hoping that the information that is provided by me regarding the financial instrument seems relevant, reliable, and you have gained something uh, new information through this video. So I'll be providing and coming with the new concepts like financial instrument and so on, because it's a very crucial and critical standards, and little bit difficult also. So anyway, I'll try to give more inputs and more knowledge about this standard later on through my videos. So hopefully you are gaining some understanding the meaning of financial instrument. If you are liking my videos, if you are liking the way I'm providing the information, so please thumbs up and subscribe my channel, share wherever it is possible in your friends, family, wherever you feel comfortable. So friends, till then, uh, good day and God bless. I will meet with new video soon. Till then, thank you very, stay blessed.